For a long time, Gap felt like a bit of a relic, right? Kind of stuck in the 90s. But then, almost out of nowhere, they just dropped a blockbuster quarter that has Wall Street talking. So, what is going on over there? Let's unpack the playbook behind this really surprising comeback. Okay, let's start with the headline number. Gap Inc. raked in nearly $4 billion in revenue last quarter. And that's not just a good number. It totally smashed what Wall Street was expecting and really signals they might be back in a big way. But this next number, this is where the story gets really interesting. Their comparable sales, which is basically a health check on how their existing stores are doing, jumped by a massive 5%. Now, to put that in perspective, that is their best performance on that metric in over 4 years. So yeah, this isn't just a random blip. It feels like a real trend. So the big question is, how did they do it? How did a company that, let's be honest, a lot of people had written off suddenly stage this incredible comeback? What's their secret sauce? Well, if you ask their CEO, Richard Dixon, there's no secret, just a plan. He calls it the reinvigoration playbook, and he says it's the engine that's driving these really consistent, impressive results. So what is in this so-called reinvigoration playbook? Let's pop the hood and take a closer look at the strategy that's putting the confidence and, the cash back into Gap Inc. Okay, so the playbook really boils down to 3 key things. First, get super clear about what each brand's purpose is. Second, you bring that purpose to life with awesome creative products and marketing. And third, you just execute flawlessly. The whole goal is to create what they call a flywheel effect, where each success just fuels the next one, leading to growth that keeps on going. So that's the theory, right? That's the plan on paper. But how is this playbook actually doing out in the real world? Let's check out the report card for Gap's biggest brands. First up, we've got to talk about the giant of the portfolio, Old Navy. They posted a stellar 6% growth in comparable sales. I mean, for a brand that big, that is a huge deal and a really clear sign that the playbook is working. And here's how they're doing it. They are just crushing it in key spots like kids and baby and their activewear line. Their denim sales are the highest they've been in years for this quarter, and their collaborations. I mean, everything from Disney's Jingle Jammies to a high-fashion designer like Anna Sue, they're creating massive buzz. They're even trying out new beauty sections in stores. Old Navy is a brand that's just firing on all cylinders right now. All right, next up, the brand that started it all, Gap. And believe it or not, they had an even more impressive quarter, with their comparable sales shooting up by 7%. This is a brand that's not just moving clothes anymore. It feels like it's reclaiming its place in pop culture. And this isn't some one-time fluke. This is their 8th straight quarter of growth. How are they doing it? Well, viral marketing campaigns like Better in Denim got them over 8 billion impressions. They're also leaning into their history with that iconic Gap hoodie and creating buzz with collabs with designers like Sandy Ling, which are bringing in a whole new, younger crowd. And the winning streak just keeps going with Banana Republic. After years of kind of struggling to find its identity, the brand is showing real signs of a turnaround with a solid 4% growth. It seems like their new focus on that modern explorer vibe is really starting to connect with people. But, and there is a but, this playbook isn't a silver bullet. While Old Navy, Gap, and Banana Republic are all soaring, there's one brand in the portfolio that is still struggling to find its way. And that raises a really critical question, right? Is this a full company-wide turnaround, or are there still some cracks in the foundation? And here's the weak spot. Athleta, their premium activewear brand, saw its comparable sales fall by a shocking 11%. That's a really jarring number, especially when you see how well the other brands are doing. So what's the plan for Athleta? Well, management is being pretty upfront about the problems. They're calling this a reset year. They're not looking for a quick, easy fix. Instead, they say they're going back to basics to get the product, the marketing, and the brand identity right for the long haul. So you've got 3 brands on a major upswing and one that's in a total reset. What does the bigger financial picture look like for Gap Inc., especially as they head into the crucial holiday season? It turns out the biggest challenge they're facing isn't a rival retailer or some fleeting fashion trend. It's tariffs. These are basically taxes on goods they import. And for a huge global company like Gap, they can really drive up costs and squeeze their profits. This slide really puts that impact into perspective. With those tariffs, Gap's operating margin is 8.5%. But if you take them away, it jumps to a much healthier 10.4%. What that tells us is that underneath these external pressures, the core business is actually really strong and profitable. So here's the bottom line. Despite the headwind from Athleta's struggles and the financial hit from tariffs, the incredible performance of Old Navy and Gap was so strong that the company actually raised its financial forecast for the rest of the year. I mean, that is a huge vote of confidence in their own comeback story. Which all leads to one final, really interesting question. Gap Inc. absolutely won the battle of the quarter. There's no doubt about it. But is their reinvigoration playbook strong enough to win the long war for the decade and secure a lasting comeback for this iconic American company? Now that is the billion-dollar question.